Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ALTRIA Group INC quarterly report. ALTRIA Group Inc. offers a diverse range of businesses and services through its subsidiaries, including manufacturing and selling smokable tobacco products under the Marlboro brand large cigars and pipe tobacco under the Black & Mild brand, moist smokeless tobacco and oral tobacco products under various brands, Copenhagen, Skoal, Red Seal, Husky, oral nicotine pouches under the ON brand e-vapor products under the NJOY ACE brand sales to distributors and large retail organizations, such as chain stores. ALTRIA Group Inc. MO stock price has seen an increase of over 12.55% in the past year, reaching $57.13 as of October 30, 2025. Several key factors have contributed to this rise, including the expansion of its share repurchase program from $1 billion to $2 billion and a quarterly dividend increase of 3.9%. These actions demonstrate management's confidence in the company's valuation and commitment to returning value to shareholders. Additionally, Altria's resilient business performance and strategic focus on evolving products have likely supported investor confidence over the year. The primary drivers of revenue growth or decline can be summarized into three main categories. Revenue decline is primarily driven by lower shipment volume and higher costs associated with the initiative in 2025, resulting in a net revenue decrease of 3.2% year-over-year. On the other hand, revenue growth is attributed to higher pricing, which contributed $1,327 million to the increase, as well as lower per-unit settlement charges. Additionally, receivables increased by 40.6%, adding $72 million to the revenue growth. Neutral factors include tariffs, which may exert additional pressure in the future, but did not have a significant impact on current revenues, and the voluntary dismissal of NJOY's appeal, which had no effect on revenue. Net income and profit margins experienced fluctuations between 2024 and 2025. Net income decreased by $2,395 million in 2025 compared to the previous year, but increased by $293 million from Q3 2024 to Q3 2025. However, a significant decrease of $873 million occurred due to goodwill impairment in Q1 2025. Profit margins also underwent changes. The gross profit margin and operating income margin decreased slightly, while the adjusted net earnings margin increased from 76% to 81%. These changes can be attributed to various factors, including settlement charges and excise taxes on products sold, which contributed to the decrease in net income. On the other hand, the oral tobacco products segment saw an increase in operating income due to lower expenses under the significant expense principle. The goodwill impairment was a result of the estimated fair value of e-vapor reporting unit being below its carrying value. This event had a substantial impact on net income, highlighting the importance of accurate financial assessments and valuations. Overall, these changes reflect the complexities and challenges faced by companies in managing their finances and making strategic decisions to maintain profitability. The company is indeed generating positive operating cash flow. The financial summary explicitly states this, and the data on pages 12 and 75 of the report confirm it. In 2025, the net cash provided by operating activities was $6,019 million, a significant increase from $5,413 million in 2024. This indicates that the company is successfully managing its finances and generating sufficient cash to support its operations. The company's debt level has shown a significant increase over the past year. As of September 30, 2025, long-term debt stands at $24,132 million, up from $23,399 million as of December 31, 2024. The current portion of long-term debt also increased to $1,569 million in 2025 compared to $1,527 million in 2024. In terms of interest expenses, the company has seen a notable decrease. For the 9 months ended 2025, interest expenses were $48 million, down from $90 million for the same period in 2024. Additionally, the net interest and other debt expense was $1,070 million in 2025, indicating a substantial reduction compared to previous years. Overall, while the company's debt level has increased, its interest expenses have decreased significantly over the past year. The company's financial performance reveals a concerning trend in the smokable products segment. Over the past year, this segment has consistently underperformed, with net revenue declining by 3.6% over 9 months and 2.8% over 3 months compared to the previous year. These decreases indicate a significant downturn in sales for this particular segment, warranting further investigation into the underlying causes of this decline. Management's outlook and strategy. ALTRIA Group is adapting to changing consumer preferences by investing in promotional activities and innovative products. The company expects to benefit from its investments in ABI and Kronos Group through increased market share, revenue growth, and cost savings. However, ALTRIA faces significant risks and uncertainties related to industry trends, regulatory changes, and competition from e-vapor category and illicit products. Management is focused on managing the company's financials to ensure long-term success, with a stable cash balance and access to credit markets. The company has also authorized a $2 billion share repurchase program to return value to shareholders. Despite these efforts, ALTRIA Group's domestic cigarette shipment volume continues to decline due to growth of flavored disposable e-vapor products and discretionary income pressures on adult tobacco consumers. Overall, management is prioritizing innovation and financial stability as the company navigates a rapidly changing industry landscape. Acquisitions and divestitures overview. ALTRIA Group Inc. has made several significant acquisitions and divestitures in recent years. On the acquisition front, the company has purchased NJOY Holdings, Inc., a leading e-vapor brand, through the NJOY transaction. Additionally, ALTRIA acquired ABI transaction in 2024, further expanding its portfolio. In terms of divestitures, ALTRIA has transferred beneficially owned JUL equity securities to JUL in March 2023 and settled federal and state derivative cases related to its interest in JUL. The company also sold the commercialization rights for IQOS system in 2024. Furthermore, ALTRIA spun off Philip Morris International, PMI, in 2008, marking a significant divestiture event. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In recent years, the company has paid out significant dividends, totaling $5.175 million in 2025 and $5.108 million in 2024. Additionally, the company has also been actively buying back shares under various repurchase programs, with a total program of $2 billion, expanded from an initial $1 billion. Concerns about inventory buildup or supply chain disruption are evident in the company's financial summary. Several factors contribute to these concerns. Tariffs introduced in 2025 have weighed on consumer confidence, impacting discretionary spending. The potential impact of tariffs on prices, availability and quality of raw materials and component parts is also a concern. Additionally, macroeconomic, climate, and geopolitical conditions may lead to significant changes in the price, availability, or quality of tobacco and other essential materials. These factors, combined with illicit trade, prohibitionist policies, shifts in crops, government restrictions, international trade disruptions, and reduced demand for tobacco leaf, pose risks to the company's supply chain. The company has implemented strategies to secure sufficient supplies, but these concerns highlight potential vulnerabilities that may impact operations. That concludes the financial summary for ALTRIA Group Inc. Feel free to comment below, and I will be happy to answer them when possible.